Hey, what's up guys? It's Kev here. This has been an absolutely brutal year for investors, especially those of us who focus on those growth stocks that started to trend in 2020. In fact, it's official that 2022 has been the worst year for the S&P 500 in over a decade. And we're definitely not out of the woods just yet either. Inflation is still really high, meaning the Fed is most likely not done raising interest rates, and economic growth is not exciting at all. In fact, we're actually pointed towards a mild recession in 2023. So naturally, as a result, investors are very hesitant to get back into the market and start putting their money to work. But hey, it's actually not all doom and gloom. In fact, I think we can see the light at the end of this tunnel. So in this video, I'm going to summarize why exactly growth stocks are down, when we'll see things turn around, and what you can do right now to position your portfolio to capitalize on growth stocks that are trading substantially below their previous valuations. So before we dig in, let's get the definition straight. What exactly is a growth stock? Simply put, it's shares in publicly traded companies that are expected to grow at a faster rate than the overall market. These companies typically have high earnings and revenue growth, and they're in industries experiencing rapid expansion. Oftentimes, these stocks are in trendy sectors, like something you might see on Wall Street bets. Now, the growth in growth stocks typically refers to revenue growth, just to be clear, not necessarily profit growth. In fact, it's very common to see wildly unprofitable growth stocks. However, investor attitudes towards this growth at all costs mentality is starting to change rapidly. Now, the difference in price that you'll pay between a non-growth stock and a growth stock is known as the valuation premium, and it's portrayed by high ratios related to price to earnings, price to free cash flow, price to sales, things like that. Now, obviously, growth stocks had an unbelievable run, starting with the lockdowns back in 2020. Now, this was a bit of a perfect storm, and there was a lot of reasons for this. Namely, governments slashed interest rates to almost nothing. Money was practically free and sloshing around everywhere. People were stuck at home, bored, receiving government stimulus checks, and overnight, everybody became a day trader. Even look at the founder of Barstool Sports, Dave Portnoy. He became known as DDTG, Davey Day Trader Global. No offense to Dave, I love Dave. He's brilliant, but he's a mega sports fan, a media guy, and he does pizza reviews. Not exactly the prime candidate to be giving advice to millions of retail investors. Now at this point, anything relevant to work from home, e-commerce, disease prevention, themes that made perfect sense with our new lockdown lifestyle, saw stocks in those sectors absolutely explode higher. For example, between March 2020, when stocks hit their lockdown low, and the end of last year, the Russell 1000 Growth Index was up 130%. I wrote a research piece back then and I sent it out to our email list where I highlighted 10 stocks that fit perfectly within those sectors and themes that I just mentioned. And in the first 5 months, the portfolio was up 159%. What's actually amazing is that most of those stocks were large caps, and returns like that with large cap stocks are not supposed to happen, but that's just how crazy those times were. However, inevitably things took a massive turn for the worst. Inflation skyrocketed, interest rates started rising, the cost of borrowing money became super expensive, consumers couldn't buy as much, and the economy started slowing, which for growth stocks is the exact opposite of what you need to see. If you're investing in a growth stock, it's because you think that by holding out and focusing on profit in the future rather than today, you'll make a lot more money. So because of that, there's something really important you need to understand called discounted cash flows. And it's actually fairly simple. So remember that we're focused on future profits. Then the question is, what is that future cash flow, let's say in 10 years, worth today? I think we can all agree that $1 million today is worth a lot more than $1 million in 10 years. The reason is that if we get that money today, we can invest it. And by the time we hit 10 years, it's going to be worth a heck of a lot more than $1 million, hopefully. So when interest rates rise, money today becomes more and more valuable because the yearly interest we can get on that money goes up. So if you're seeing where I'm going with this, when interest rates rise, growth stocks and their future cash flows become worth a lot less today. Now, additionally, people are concerned about the overall health of the economy, and rightly so. When rates rise, it impacts the value of everything from real estate, stocks, bonds, you name it, leaving people with what's called a negative wealth effect that often causes people to spend less. Less spending means a slower economy. A slower economy often means layoffs. Layoffs means even less spending, and so on and so forth. If you're a highly priced growth stock, you need to be growing quickly in order to justify the high price tag on your stock. Slower growth means these companies likely aren't going to hit the revenue targets that investors and analysts had priced in. And that's exactly what happened. Netflix is arguably a perfect example of this. Let's rewind all the way back to April when Netflix shares collapsed 37% in a single day after the company reported earnings. Revenue actually grew to $7.9 billion, which was right in line with analyst estimates. But there were two main issues for this growth stock. First, revenue growth was up, sure. but 10% doesn't exactly cut it. Second, in spite of earnings per share absolutely crushing analyst estimates, for the first time, they actually lost subscribers. This really shows you the expectations that are put on growth stocks with massive valuations. Now, one thing we know about markets is they are cyclical. Market goes up, people get euphoric, they tend to forget about fundamentals. Then they get a cold glass of water to the face, and it all comes back to them. And generally, stocks get sent back down. Some of your favorite companies are likely trading at bargain basement prices right now. Many of them anyways. The irony is that investors line up to buy stocks when they're trading at their highs, but as soon as they're on sale, they're nowhere to be found. So for the more fun part of this video, when exactly do we think things will turn around? Now, of course, it's nearly impossible to predict the future price of stocks, but there's a few things we can look for that'll give us a clue. Now, the main thing to watch out for is inflation and interest rates. As long as inflation is high as it is now, interest rates will still most likely rise, perpetuating the whole chain reaction that I just discussed. As soon as inflation cools off to something more like 3 or 4% versus 6-7% plus, the Fed will likely be able to take a breath, and the possibility of an eventual interest rate cut will actually be on the horizon. Another factor is an improvement in the overall economy. It's much easier for a growth stock to achieve their growth targets if they've got an overall economy that's growing with them. However, in the near term, it's far more likely we'll hit a mild recession, depending who you ask. But if economic growth shows up that's maybe not good, but not terrible, sometimes that's enough to ignite a rally. Now remember, the stock market looks way ahead, so it's not pricing in how the economy is doing right now, but how it will be doing down the line. Now, finally, growth stocks may become more attractive if they fall in price even more. The reason is because there's a big difference between a good company and a good investment. If you're paying way too much for something, in this case a stock, no matter how good it is, it becomes impossible to make money if the price is already way too high. So there comes a time when good companies are trading at such a low valuation that investors just simply can't ignore it. And now the most important part of the video, what can you do right now to position yourself for the eventual rebound in all of these beaten up growth stocks that you know and love? Okay, now that we have an idea of a few things you can look for to spot a possible turnaround in these stocks, there are a few company-specific things you can look for as you're looking to add positions to your portfolio. Now, first of all, every growth stock I've looked at has fallen in price in a major way. And generally speaking, if you're a long-term investor in a stock, short-term fluctuations shouldn't matter all too much. However, there's two situations where it really does matter. Namely, when these companies in your portfolio are looking to raise capital or make acquisitions. In either of these situations, it's imperative that you have a high or at least fairly valued share price, so that dilution is kept to a minimum when you issue new shares for the acquisition or for raising new capital. Now, keep in mind in these situations, I'm ignoring all cash acquisitions, so just bear with me. It really sucks for companies to raise money at these valuations because the shareholders that are existing are going to get diluted so much. With that being said, it's better to be diluted than dead. However, we want to avoid dilution as much as possible. To illustrate what I mean, let's say two companies both need to raise $1 million. If one has a valuation of $10 million, then they have to issue 10% more shares in order to raise that $1 million. If the other has a valuation of $100 million, they only need to issue 1% more shares to raise that same $1 million. So to avoid inevitable dilution, look for companies with healthy balance sheets and healthy cash flows. If it's a company that runs net losses, ideally they'll have cash on the balance sheet to cover them for another 12 months. To figure out the cash runway, go to the quarterly statements, look at the net loss for the period, take that number, divide it by 3. Then take the cash on the balance sheet and divide that by the monthly cash burn. That's going to tell you how much of a runway this company has, more or less. It's a crude measurement, but it'll do the trick for this case. Now, if it's a free cash flow positive company, you're already in much better shape because they likely won't need to raise capital unless it's for a really good opportunity. Now, second, find companies with really robust revenue streams. A rising economy lifts all boats, and the reverse is true when the economy is shrinking. Now, value stocks, they're generally trading at good value because they've either passed their peak growth phase or they've been beaten up for some other reason. And when the economy is shrinking, ideally you want a company that can keep growing. So in addition to looking for companies with revenue that's continuously growing, try to find revenue streams that aren't going to be impacted by a recession. People still need fuel for their cars, technology for the workplace. Healthcare is often covered by governments or insurance. You get the point. Last of all is to not try too hard to time your entry point. We generally know what to look for to see a turnaround, but you can expect to be surprised. Markets are never rational, and sometimes we can be waiting for good news when not terrible news is all we really needed to see. So for that reason, don't try too hard to time your entry point. Stocks are way cheaper now than they were when everyone was being irrational in the last market rally, so no matter what, you're getting a comparatively good entry point. Put some of your money to work now and then slowly average in every month over the next 12 months into your favorite companies. Now, when it comes to penny stocks, it's actually quite different. I'm seeing some of the most attractive trade possibilities that I've seen in a very, very long time. However, in this case, the number one thing you need to look for, in my opinion, is bankruptcy risk. We're gonna see a lot of penny stocks going absolutely belly up this year. And in fact, it's happening already. Now, however, there's lots of companies trading at less than the cash on the balance sheet or a fraction of their revenue, creating amazing value opportunities here. And these are for companies that are not only value opportunities, but actually growth as well. For these quality companies, as long as they can grow marginally and just stay alive, it's realistic to think they should see a large price correction upwards in the not so distant future. Now, if you're not following our newsletter, you absolutely should. I'll leave a link in the caption below. It's free, and both myself and my full-time analyst Declan, we look through small cap stocks, typically 300 million to 2 billion in market cap, and we're finding a ton of amazing opportunities. If this is something that interests you, definitely subscribe, but also take a look at this video here I'm gonna throw up on the screen, going over my rules that I live by to trade penny stocks, and that's how I've made a lot of my money. If you enjoyed this video, give it a thumbs up, subscribe. We got a lot more content coming your way. This is an exciting time to be an investor, even though it feels a little bit scary. But thanks for watching, guys. This is Kevin. I'll see you next time.